Hey everyone, it's Shant coming at you guys with a St. Patrick's Day or almost St. Patrick's Day edition of our market update. So it's mid-March. We got a big Fed meeting announcement today. We're waiting for big topic of conversation right now has been interest rates. Never gotten more question on interest rates and what's going on with them. So obviously we talked about it last year. We made our predictions. We kind of kept you looped in on what's going on in 2020, 2021, and what was on tap for 2022. And you know, it's been totally a little bit unexpected in terms of how fast rates have gone up. So we knew rates were going to go up this year. The Fed signaled that. They started signaling that at the end of the year, really at November. They kind of said, hey, we got to change monetary policy to start dealing with inflation, which we'll talk about in a second. And they said, all the reports we started seeing from Fannie Mae and Freddie Mac and Mortgage Bankers Association, we're starting to talk about rates in the mid to high threes, and then even 4% as targets, but all by the end of 2022. Here we are at the beginning of the spring market in 2022, and the 30-year fixed rate average has now surpassed 4%. So we're seeing reports from Freddie Mac, from Mortgage News Daily, from the MBA that we're all seeing rates on the average 30-year fixed conventional rate 4%. Now, to give you some point of reference, at the beginning of this year, in early January, the rate was right around 3.3%. In most of 2020 and 2021, the average 30-year fixed rates were hovering in the high twos. So now we're talking about 4%. So again, we knew we'd get here. We certainly didn't think we'd get here this fast. So what's going on? Why have rates gone up so fast? And simply put, it's inflation. As a reminder, at the beginning of the pandemic in 2020, the government made a decision. They're not going to let a health crisis turn into a financial crisis. So they pumped the economy full of cash. And the stimulus programs that they rolled out for a larger part worked. Housing market surged, our economy surged, the stock market did great, but now we're paying for that a little bit in the sense that we're seeing a 40-year high in terms of inflation numbers. Some of the inflation numbers that have just come out recently are as high as 8%, and some are predicting inflation numbers at 10%. Now, the Fed was saying at the beginning of this whole thing that, like last year, they used to call inflation transitory. They've removed that term towards the end of last year. Now we've got runaway inflation. So big problem that we're dealing with, and that's why rates are going up. So, at the beginning of March, since the beginning of March, we've already seen rates go up just 0.5% in the last 2 weeks. So what happened then was Fed Chairman Powell came out and confirmed that the central bank will start hiking rates as of actually today. We're expected to get that announcement in a couple of weeks that rates will start hiking. The Fed rates are going to start hiking today. So we're expecting a 0.25% rate hike. So some people are predicting as many as 5 rate hikes this year, some of them being 0.25% to 50 basis points, right? The Fed is also reducing their treasury purchases, their mortgage-backed security purchases, and even talking about reducing their balance sheet. So they're really trying to change and undo some of the economic stimulus they did over the course of the last couple of years, and the mortgage rate market is, reacting to that. So, so testifying before Congress, he said, we're going to remove pandemic stimulus as our country scuffles with runaway inflation and massive supply chain issues, right? And they also did mention that, a lot of things I've heard, well, with this terrible situation in the Ukraine, that, maybe they would pull back on some of that, maybe not hike rates as much. And they pretty much came out and said their view on it is that it's a terrible humanitarian crisis, but their number one core purpose right now with what the Fed and central bank's policy is to get inflation under control. So they're going to go ahead with their plan, although they're going to watch that situation carefully. Obviously, it could have some impacts in terms of supply chain and other issues, and it could actually feed into inflation even more, as we've seen oil prices hike big time since that's all started. So, what's going on with inflation is ultimately, just so we're all on the same page, inflation causes goods and services, all those prices to go way up, right? So we've seen things like food, energy, oil, gas, rents, cars, both new and used, et cetera, spike in price. Things have never been more expensive. In fact, think of anything that you're purchasing now is like anything cheaper than it was just a couple of years ago. The answer is no, everything's more expensive. So the way the Fed is looking at this is that, if we increase borrowing costs, typically people spend money with the money they borrow. So think about loans, think about credit cards. All major purchases are usually used on debt. So as the debt gets more expensive, it reduces people's ability to either take it on because they obviously have to pay it back at higher rates. So just like when you make money cheap, it spurs spending. When you raise rates, that does the opposite, and it makes people hoard cash and spend less. So that's why rates that's why the Fed is hiking rates, and that's why they think they have to do. It's the biggest tool in their tool shed in terms of getting inflation under control. So inflation's at 8%, headed to 10%. Their goal is to get it down to 2%. So that's what's going on. So as a point of reference, right, and this is important for everybody to understand. So in November of 2021, right, the average 30-year fixed rate at the beginning of the month was 2.875. Here we are in the middle of March of 2022. The average 30-year fixed rate is now about 4.25%. Okay, the cost, okay, since then, okay, in terms of increased payment on a $520,000 mortgage, if somebody took out a $520,000 mortgage in November of 2021 versus March of 2022, that same mortgage payment is $400 a month higher today, just in a few months. That's about $100,000 in buying power that the average homeowner has potentially lost, right? So it's really important to understand how it impacts your budget as rates go up. Now, the question I get asked every single day is, of course, with rates rising, it's going to bring home prices down. And I actually don't think it's going to do that. And here's my reasons why. Inventory is at an all-time low, okay? There's way more demand than supply, okay? Inventory is down 25% year over year and almost down 48% since 2020, okay? So we've got a massive shortage of homes for sale. There's massive demand in terms of people wanting to buy homes across our country. Every single market out there is super hot. Rents are going up just as fast as home prices. So the alternative to owning a home is renting. And so when you look at your rent prices going up and lease renewals and all that kind of stuff versus owning a house, it's equally expensive to do one or the other. So at least when you own a home, you're paying principal, you're getting tax deductible interest, your home's appreciating, at record clips, 20% year over year the last few years, housing is obviously a great hedge against inflation. There's a ton of wealth in our country, so there's a lot of money that's ready to be spent as income's gone up across the nation about 6% year over year. And obviously, we've seen massive gains in our markets, in the U.S. equity markets over the last couple of years, and that's what people are using to fuel their down payments and obviously increases consumer confidence. Homeownership's embedded in the psyche of Americans. I think homeownership will always be expensive, and demographics there's this new group of the biggest population of home buyers out there is millennials, and the biggest population of them is just about to hit their prime home buying years, right? And then ultimately, we all know that rates go up and down. So even if you get a rate now in the high threes, low fours, as rates, rates may keep going up. Odds are at some point they'll come back down, and you can refinance into lower rates as well. So I don't think that this rate increase is going to slow down our market. We saw the same thing happen in 2018, where at the beginning of the year rates were in the low threes. By the end of the year, they were almost at 5%. In 2018, at the time, was a record year, and things were very robust throughout the entire year. What I'm seeing right now in the market is I am seeing intensity we've never seen. And I said that last year, and I said the year before, but it's getting more and more intense as inventory gets lower. And on top of that, you've got more qualified buyers out there. So new applications for pre-approvals, all-time high for the year for us. Okay, we're seeing people get pre-approved. It's new people entering the market or previous potential buyers that are re-upping their applications and getting ready to buy again in the spring market. Okay, inventory has definitely increased over the course of the last 2 weeks. So we are mid-March. Definitely the last 2 weeks we've seen inventory increase. So two things happen when inventory increases. One, we're noticing a huge increase in accepted offers for our buyers, which is great news. And then two, we see more applications come in because what tends to motivate buyers to get actually pre-approved and start the mortgage process is when they see a home they like. Okay, we're seeing super aggressive bids. So the amount of people that I'm seeing make over asking or over list price bids is like nothing we've ever seen before. 100,000, 200, 300, 400,000. Nothing is surprising me anymore in terms of the intensity and the aggressiveness of the offer. Okay, we're seeing waived contingencies. So we're having a lot of clients waive inspections. We're seeing a lot of clients waive mortgage contingencies, appraisal contingencies. Certainly if you're thinking about doing any of those things, we're happy to talk about the pros and the cons with all those type of things. We're seeing, what I am seeing, and I want everybody to know, is that buyers are winning. So we are seeing buyers actually get offers accepted with mortgages. there's a, sometimes we hear things like, oh, if you're not an all cash buyer, there's no chance you're going to win. That's absolutely not true. I'm busy. I know a lot of counterparts across the industry are busy. So mortgage companies are definitely doing a lot of purchase volume. As a side note, we're predicting to increase our purchase volume by about 10 to 15% just by all the metrics we're watching. So there's definitely gonna be a lot of mortgage buyers winning. Just this last week, us personally, we had over 75 buyer clients have their offers accepted and go into process to close on their houses. And just in this past 2 days to start this week already, we've already had over 30 clients have offers accepted. So there's a lot of people with mortgages. Our clients are definitely winning. I think the key to that whole thing, though, and I think the reason our clients are separating themselves from the competition, what I'm observing, what I'm noticing, is that they are separating themselves from the competition, and they're able to put themselves in a position where they can even compete with cash buyers because they're getting pre-committed. They're offering super quick closings, where you can close a loan in 10 to 14 days, 2 weeks, 3 weeks, 4 weeks, whatever it is, we can execute and make it happen. The communication and the availability to clients, it's a, intense market. Like I said, you need to be available to your clients. You need to answer their questions. You need to make sure they're prepared, they're confident, they're understanding of all the implications of winning the bid and getting their offer accepted. And then just the relationships we have amongst the real estate community and the reputation we have is certainly helping in terms of when listing agents and sellers need to make a decision on whose offer they're going to accept when they have 20. So I think all those things are helping our clients win. Lastly, one other observation I'm seeing for current homeowners is the amount of cash out refinances that we're seeing across the industry has skyrocketed. So a lot of people got their refinances in. A lot of homeowners got their refinances in when rates bottomed out in 2020 and 2021. Okay, and so we've seen rate and term refinances plunge for sure. Okay, but we have seen as home ownership has reached, as home equity has reached all-time highs, people tapping into their homes, their home equity for cash out refinances. Okay, we're seeing people tap into home equity to consolidate debt, high interest rate debt. Home improvements is a big one in terms of taking out equity from their homes to do all the upgrades, renovations, remodels that they've always wanted to do to add more value to their homes and make it more customized for what they need. We're seeing people take cash out for future investments, whether it's for alternative type investment or for purchasing their next home, whether it's second home, investment property, next primary residence, if you're upsizing or downsizing. So in Q4 alone, homeowners tapped $80 billion in equity, the highest in 15 years. Okay, so it's the highest in 15 years, going back to 2006 actually, so maybe 16 years. But it's something we're seeing a lot of. So if it's something you want to chat about, if you're a homeowner that wants to discuss cash out refinance, obviously something we'd love to help you with. So that's all I got today. Happy to help with anything. Email me at shant@rate.com or send us a direct message. Hope everybody has a great St. Patrick's Day.